Every customer that walks in here leave happy that they've experienced superior service.
Okay, when it comes to customer service, I would say you have, a very dedicated team, well trained. They know exactly what they are doing.
Every customer that walks in here leave happy that they've experienced superior service.
Good afternoon, everyone. Thank you for joining this webinar. My name is George Gabla, and I'm your moderator for today. On behalf of everyone, I would like to thank First Atlantic Bank for organizing this event. The main purpose is to provide knowledge to the industry. As a bank, we will also want to thank the Bank of Ghana, the SEC, our customers, our partners and investors, particularly AFID from Senegal, the board of directors, and also thanks to Loretta Joseph for accepting to speak to this subject. The theme for today's session is blockchain, cryptocurrencies, digital assets, and the regulatory and banking perspective. During this session, you can send your questions via the Q&A button below your screen. At this point, I'd like to show a very short video to introduce the subject. This is the video.
What if there's a technological advancement so powerful that it transforms the very basic pillars of our society? A technology which fundamentally influences the way that our economy, governance systems, and businesses function, and could change our conceptual understanding of trade, ownership, and trust. This technology already exists, and it's called cryptocurrency. People often think of cryptocurrency as only virtual money or a transaction system. But if you look closer, you'll see that the monetary aspect is just the tip of the iceberg. That's because cryptocurrency is a groundbreaking internet technology for which money is merely one of the possible applications. Cryptocurrency enables a network of computers to maintain a collective bookkeeping via the internet. This bookkeeping is neither closed nor in control of one party. Rather, it is public and available in one digital ledger, which is fully distributed across the network. We call this the blockchain. In the blockchain, all transactions are logged, including information on the time, date, participants, and amount of every single transaction. Each node in the network owns a full copy of the blockchain. On the basis of complicated, state-of-the-art mathematical principles, the transactions are verified by the so-called cryptocurrency miners, who maintain the ledger. The mathematical principles also ensure that these nodes automatically and continuously agree about the current state of the ledger and every transaction in it. If anyone attempts to corrupt a transaction, the nodes will not arrive at a consensus, and hence will refuse to incorporate the transaction in the blockchain. So every transaction is public, and thousands of nodes unanimously agree that a transaction has occurred on date X at time Y. It's almost like there's a notary present at every transaction. This way, everyone has access to a shared single source of truth. This is why we can always trust the blockchain. And each cryptocurrency is both individually identifiable and programmable. This means that users can assign properties to each unit. Users can program a unit to represent a eurocent, or a share in a company, a kilowatt hour of energy, or a digital certificate of ownership. Automizing such matters leads to a considerable decrease in bureaucracy, which saves accountants, controllers, and the organization in general an incredible amount of time. But there's more. In an Internet of Things, our economy will be dealing with machines that actively participate in the economic traffic. In fact, they're already here. Think of a vending machine, or drones delivering packages. These machines are unfamiliar with the concept of trust. Because of the blockchain, the drone can be 100% certain that it will deliver the package to the right recipient and know for sure that it's been paid for. And we can program the vending machine in such a way that it will automatically keep track of its supplies, order new supplies from the supplier, and pay for them automatically. Of course, you'll understand that this is only the beginning. Internet technology is disruptive and breaks the status quo. It opens markets and breaks the positions of middlemen all the time. The blockchain and cryptocurrencies have caused a paradigm shift. It's time to explore this new technology constructively and critically, and openly discuss potential applications.
Okay, welcome back. It's time to unpack. And I believe this will be done by Loretta Joseph. She happens to be a consultant and also a fintech blockchain advisor with over 25 years of experience in the financial market and related sectors. Loretta, your attendees, please.
Thank you so much, George. First on the onset, I'd like to say a big thank you to Odon, who organised this webinar in record time, and a very big thank you to First Atlantic Bank. Hopefully by the end of this session, so blockchain, cryptocurrencies and digital assets, you will have a understanding of the perspective from regulators and from banking. I hope that I'm going to unbundle the mysteries of cryptocurrencies for you and give you some definitions and some examples of what blockchain is all about. So to start off with, hopefully at the end of this, you're going to know everything about blockchain. I also have a very large private and personal reference documents that I've gained over the last 9 years. I'm very happy to share that with everyone. It's got YouTube videos, pieces by the FATF, by different organisations, by regulators. It's very, very useful. So I'll share that with the organisers straight after this. So my background, just so you know, I was a banker for 25 years. I've been a managing director of a bank, Royal Bank of Scotland in India. I've worked for Australian banks. I spent most of my career trading derivatives and futures. And so I've had exposure to every asset class there is. I'm very passionate about technology. I'm very passionate about innovation. I have a 16-year-old myself, and I believe that we're never too old to learn. So I first got into looking at blockchain and cryptocurrencies way long ago in 2012, when it wasn't cool. In 2014, in Australia, I looked at cryptocurrencies, but I actually looked at the underlying technology, and I used it to solve, in my life as a trader, the biggest problem I could see, which was clearing and settlement of systems. It's clearing and settlement of equities. Sometimes the clearing and settlement of a bond can take 3 days, of an equity 3 days, a water title 27 days. So I actually looked at this from the technology side before I looked at the application. So I was a very early innovator in fintech in Australia. fast forward 2014 and 15, I really started to look at blockchain, and I'll get into what the technology is in a minute. But I wrote the first self-regulation for Bitcoin in Australia, and I had the double GST removed. I started to look at laws, and I worked out that the Australian Corporations Act, which most of the financial services come under, was not technology agnostic. So to build the pilot I did for clearing and settlement, move quickly from that, from 2016 to 17, I started to see what I'd written around Bitcoin be taken up by many jurisdictions. And then in 2017, I was at Davos. I got approached by the Premier of Bermuda, who asked me if I'd come to Bermuda and write their Digital Asset Business Act. And I said, well, I'm not going to do that. And he convinced me to do it. So I helped draft and legislate the first Digital Asset Business Act in the world, which is in Bermuda. We wrote the first regulation and bill around initial coin offerings. Since then, I've advised a number of central banks, large organisations like the OSCE, the OECD. I work with the FATF. I work with a number of law enforcements, because we all need to be on the same page. And I have this hashtag, collaboration is the new survival. We as industry, policymakers and governments, nobody has the answers with this very new technology. So we really all need to be on the same page and to work through this, because the internet taught us that the walled garden approach to regulation just doesn't work. So we're going to go back to the beginning. In 2008, I was a bond trader, and I think hopefully some of you remember that the financial crisis, the GFC, caused many people to start to think, did we really trust the institutions and the banks and third parties that were the best guardians of the global financial system? Now, we know that the Lehman Brothers brought down, effectively a crash that affected us, and still probably does, by bad investment decisions by major banks, bad trading decisions, and they proved catastrophic with rippling consequences. So in 2008, a group of people called Satoshi Nakamoto put onto the internet a white paper that was 8 pages. Please all go and have a look at it. It's the PDF. It was called Bitcoin White Paper. And it talks in those 8 pages about a peer-to-peer cashless payment system. It combines cryptography, which has been around since the Second World War. So that's encrypting data so it stays secure. And it combined what the internet gave us, a peer-to-peer transfer of value over an open network. So this was the borning of Bitcoin, which was the first application of the underlying technology blockchain. It was also showed us that this application was the digitalization of money. Now I'll get into that in a bit, because money means something different to everybody. Money can be a store of value. It can be a payment system. Money itself comes out of barter. We used to barter thousands of years ago crops between each other. Then we moved to stones, or we moved to shells. Then somehow or other we got onto coins, and we got onto gold, and then we got rid of all that and went to paper. So the evolution of fiat currency is different from money. So as I said, everybody's got a different view on what money is, but it's a good one to sort of put out there first. So cryptocurrencies are now part of a larger new asset class that we've seen, and I've written laws about this, and in Australia we started to call it the digital assets. So cryptocurrencies are just a subset of a digital asset. We can now, with blockchain technology, digitalize any asset. So now we have the ability to digitalize any asset class that exists, tangibly or intangibly. But these cryptocurrencies, I'm going to dig into that a bit. They're very volatile. They're very speculative. Buyer beware. They are a speculative tool. So I think I will get into it in a bit of detail, but Bitcoin is more of a store of value. It's more like digital gold. It has a fixed supply. 23 million Bitcoin only exist that Satoshi created. We've mined, and I'll get into what miners do, about 18 million of those. So it's a finite supply, very much with characteristics akin to a commodity. So that's why a lot of people just call it digital gold. Oh, just go back on. So what is blockchain? So blockchain offers us a way for untrusted parties to reach agreement, which we call consensus, on a common digital history. So a common digital history is important because digital assets and transactions are in theory easily faked. You know, if you go pirated videos, you go onto the internet, there's copies, and that's a problem. So blockchain technology actually solves this. So what is blockchain? All of you use databases, I think every single day of your life. We all have databases. Now, the databases we use are what we call centralized. They're owned by somebody and they're kept in the same server. But the blockchain technology is immutable, it's transparent, it's secure, it's permissionless and trustless. It's a decentralized database. So instead of having a centralized control, nobody owns this database. Thousands and thousands of computers around the world plug into this database, and the decentralized nature of it makes it extremely secure and safe. So there are different types of blockchains. You've probably heard all of Bitcoin. Bitcoin is the biggest blockchain. It's a public blockchain. So that means that anybody in the world with a computer can log into the Bitcoin blockchain. Now, what that means also is that it's very secure because there's no point of vulnerability in a centralized server. So hundreds and thousands and now probably millions of computers around the world are all looking at the same ledger. All of us in this room, we're all looking at the same ledger, and it's what we call a single source of truth. So nobody controls it. So in a bit further into how this works in. So in a decentralized ledger, in a Bitcoin itself is a digital and global money system. That's what it was built for. But Bitcoin in itself was never built to be a payment system. This is very important to know. It's very slow and it's very clunky because it's very secure. As I said, it's the most secure database we've ever seen in history. And it solved the security problem of the internet. Now, my biggest mentor, who I'm very lucky to have, is Robert Kahn. So Robert Kahn is the father of the internet. He created the internet protocol and the transmission control protocol. So I use him a lot to understand what it means to create an open system, open source network that everybody can access. So the one problem with the internet, though, it's not secure. We can transfer value between all of us, but we all know it can be hacked, information can be stolen, and that's not good. The next problem Bitcoin solved was the double spend. This has been the biggest problem in accounting history for hundreds of years. So it's Bitcoin in, Bitcoin out. And because it's peer-to-peer, there's no middleman between me giving George my Bitcoin on my telephone using internet technology. There's no middleman. I don't need to trust a bank, another intermediaries to do that transaction. So I can pass my Bitcoin in a wallet to George. Now, what happens is that every other computer in the network is looking at that transaction. They're going, does Loretta have the Bitcoin to give to George? Okay, yes, she does it, and I've done the transaction. So everybody verifies that that transaction is correct and it actually occurred. So you can't double spend a Bitcoin. And the ledger, as I said, lives on everybody's computers. So we all see the ledger. If anybody tries to corrupt it or change it, everybody in the ledger will say no. So immutable means you can't change the ledger. We go by what we call the consensus mechanism. So that's the governance model of the network. It's opt-in or opt-out. If you opt into the Bitcoin network, you have to essentially agree to playing by the rules. So it doesn't matter how big you are or how small you are, 80% of that network have to agree to a change in the network, in the governance protocol. Every transaction is time-stamped and dated, and the miners, they validate the network, they keep it, the integrity of the network. And it's governed by mathematics. So we trust that 1 + 1 = 2. We no longer have to trust a third-party intermediary to tell us that we've done a transaction. So this is just on a bit on the technical side. A block is just a large amount of information. So it's records. It can be date of birth, address, yada, yada, yada. The first block is there, and it's linked by cryptography to other blocks. So that's what we call it, the blockchain. So there's chains of blocks that are all linked together. It's time-stamped, so the blocks form a chain of data as an asset. As the Bitcoin moves, it changes hands or it changes ownership. The transactions are confirmed in each block, and you cannot alter them. So the Genesis block is the first block that you ever see. You can still now go onto the internet and look at the Genesis block of the Bitcoin network. Hash, it's a function that converts an import of letters and numbers into an agreed encrypted output. So that's what we call hashing. So that makes the network extremely safe. The algorithm that Bitcoin uses is the SHA-250 hash mechanism, and it's very complex. It revolves around a lot of algorithms, but it's very, very secure. So the uses of blockchain, I'm just going back here. Another blockchain I'm going to introduce you to at this point is the Ethereum blockchain. So the Bitcoin blockchain was the first and it's the biggest. In 2012, there came another blockchain called Ethereum, which is not built on the Bitcoin blockchain or a variant of that. It was built on its own blockchain. It has its own native currency. And the Ethereum network is very interesting because it created something known as smart contracts. So to speed transactions up, I just explained to you that Bitcoin transactions were very slow, they're clunky. So to speed up a transaction, they created a set of rules, which we call a smart contract, which is stored on the blockchain and it executes transactions automatically. So the smart contract can define what conditions need to be met, say from contract A to be executed to state B. So examples of that, it's just executing code. So they're not smart and they're not contracts, but they were called by the community smart contracts because that sounds groovy. So bond transfers, you can also do the terms of travel insurance, buying and selling homes. So the blockchain use cases go way beyond the digitalization of money, which effectively Bitcoin is. We can now see digital rights being transferred on the blockchain. Digital ID is one of the best use cases that I see. We can now move equity rights, anything that has a registry function, we can now digitally represent on a blockchain and start to trade that. So that's an interesting thing too, because if you take gold in its hard form, it's very hard to move. It's a very illiquid asset. And other than wearing it, I don't really ever see the word used for gold, but people think it's valuable. So if people think anything is valuable, that they will buy it. But if we could digitally represent gold on the blockchain, we can create secondary market functions and make these illiquid assets that we have are liquid. And we can now see new asset classes that we haven't even thought about starting to come into existence. Things like supply chain, provenance of good are being used now with blockchain technology. And what you're seeing in that video I showed you, it's a emulsion of different emerging technologies. Blockchain can't stand on its own, but neither can artificial intelligence or the Internet of Things. And we're seeing this acceleration of technology getting faster and faster and faster, and they're all coming together. So that's the interesting thing. So when do you need a blockchain? I find this very interesting because people come to me all the time and say, Loretta, we need a blockchain. And I say, well, why? And they go, because we need one. And that's not a good reason. The only time you ever need a blockchain, and please write this down, is when you have collaborators and competitors in a network that need to share information but don't trust each other. That's the only time you need a blockchain. If you're sharing data with someone you trust, with another party, you don't need a blockchain. If you're sharing data with two parties that you trust, you don't need a blockchain. If you've got three more parties in a network that don't trust each other, a blockchain is good, but have a look, because all you might need is a better encrypted database. So there's people creating blockchains out there that really aren't solving any real life problems, and all they really need is an encrypted database. So that's a very important thing to note. So now this is a big demeanor. I would like to go into a bit of what is a coin and what is a token, because you've all heard of Bitcoin, you've probably all heard of Ethereum, some of these other coins and tokens. So it's really important that I think if the Bitcoin protocol developers had have called Bitcoin Zen token, nobody in a central bank would have been upset. No regulators would have been worried what we're talking about. And and initial coin offerings, had they have been called initial business offerings, they're just digital crowd funds, we wouldn't have had all these conflicting terms. Virtual assets, digital assets, crypto assets, virtual assets, all these things are actually talking about the same thing, but we haven't had a defined dictionary. And that's what I've spent the last 5-6 years of my life doing, is if we all need to be on the same page and talk about exactly the same definition, because at the moment the world is talking about different things, but they all mean the same. It's very confusing. So in a nutshell, an altcoin, the Bitcoin was the first public blockchain protocol that came out. Since then, we've got thousands of cryptocurrencies. I mean, I think there was something like 8,000 coming into existence over the last couple of months. Altcoins simply refer to a coin that is an alternative to Bitcoin. The majority of altcoins are actually just variants or forks of the Bitcoin network, because don't forget, all these networks are open source. They're there for everybody to use, to build on. They're completely transparent. And the original protocol can be changed by building on top of it. So many different cryptocurrencies have used the original code, source code of Bitcoin, and built other coins on top of it. And they've got different sets of governing rules around them. And then there are other altcoins that are derived from Bitcoin. I talked a little bit about Ethereum. They're also open source. So Ethereum and Ripple and other cryptocurrencies which actually sit on top of their own blockchains, and they had their own native cryptocurrencies as well. So Ethereum and Ripple are good examples of those. I think it's important to note, though, that what is blockchain? Blockchain is just the technology that underpins cryptocurrencies and other use cases of the technology. But it's also important to note that when you're looking at these protocols, what are they doing? So essentially, Bitcoin added a security protocol layer to the internet like we've never seen. So as I said, my friend Bob, who built the internet, you know, the one thing he said to me, it was not designed into the internet to have a security protocol. But from the first transmission control protocol that he wrote and the internet protocol, he sent a message across an open network to a man called Vincent that said, hello. So that was the start of the internet protocol. Now, we all use the internet every day. Thank you, Bob. We don't know, but there's something like 39 other protocol layers that have been embedded on top of that first internet protocol. And we just use it now on our telephones. So what Bitcoin did, it created this new secure protocol layer on top of the internet. What you were seeing with all these new cryptocurrencies that are coming in, these different protocols, many of them won't survive. It's a bit like the dot-com bubble. Many of them will not be survived, but the ones that do will come together and they will create this incredibly hard infrastructure. So we won't be worried about cryptocurrencies, I think, in 5 to 10 years. All we will see is an infrastructure protocol layer that cryptocurrencies and blockchain have built. So tokens, I'm just quickly going to run back on that. So tokens are a representation of a particular asset or utility. So they usually reside on top of another blockchain. Like I said, Ethereum created smart contracts. There's many tokens that sit on top of the Ethereum network. The tokens basically represent any asset that is fungible and tradable, from commodities to loyalty points to other cryptocurrencies. So the tokenization of assets is what we're seeing now with this revolution in cryptocurrencies. To me, is much more exciting than just the cryptocurrencies, because as I said to you, it's going to open up new ways of secondary markets, new asset classes are going to come into existence that we haven't even thought possible, but this new technology, blockchain, is allowing them. ICOs were a phenomena. When I was in Bermuda, I wrote the first legislation around them, and they're called initial coin offerings. So they're effectively digital crowd funds. Now, the problem with these digital crowd funds, they were funded in Bitcoin or Ethereum. And everybody that was doing them, 98% of them were scams. So there was no regulation. It was the Wild West. People were issuing white papers or 6 pages on the internet, and people were giving them money, and then the projects would die. They should have been called initial business offerings again. So the minute you put coin into a sentence, you upset regulators across regulations, and these things needed some regulation. So when we started to write regulation in 2018, the scams and the bad players in initial coin offerings seem to disappear. So I'm very cognizant that regulation is very good, but regulation can't stifle innovation. Regulators are not, and policymakers are not technologists, and generally technologists are not policy and regulators. So that's why it's important that we all come together and figure out the new way that we're going forward. So how is crypto traded? Crypto is traded on what they call, again, used by the ecosystem, cryptocurrency exchanges. I've run security exchanges. I've built mechanisms for trading on securities exchanges, and these things are not security exchanges. They are nothing more than digital asset marketplaces. Again, the ecosystem borrowed the terminology, which was a bit naughty, and so we in the bankers, old school regulators, central banks get a bit confused when they start confusing terms of reference. So they're not. There's nothing like novation done. I say that security exchanges around the world perform novation and they take on risk between trades. These exchanges don't do that, so they just match the buyers and sellers. They're all private. The cryptocurrencies are usually traded in a pair, Bitcoin versus Ethereum, Bitcoin to the US dollar. They're very volatile. They're very largely unregulated. It's very easy to put fiat currency into them, but it's very hard to get it out. And I'll get into the AML CTF requirements around that. So around the regulation and guidance that I've been writing for the last couple of years, I think it's important because I've said that cryptocurrencies are just a subset of digital assets. Now, I've told you with the whole tokenization of asset classes, they're just a subset, but they are in their entirety, they are still an important subset. Unlike fiat currencies, I had said in my laws categorically, this is not legal tender. So I think for all the central bank governors, the central bank employees sitting out there, that might make you feel a bit more comfortable, because although they have value and they're exchangeable for other things that have value, they show characteristics that are more like physical commodities such as grains and precious metals. So when I first started writing regulation and I was trying to figure out what a cryptocurrency was, I spent a lot of time in the ecosystem. Now, the people that built this ecosystem, built the cryptocurrency protocols, most of them are very young. They're quite autistic. They're technologists. They don't like governments, they don't like regulators, they don't really like people. So it's very hard for me to start to be the bridge between the very centralized world and the regulators world and what these technologists were building. 98% of them just want to build businesses, and they don't understand AML, CTF, they don't certainly understand regulations. So I sort of came in and I was trying to bridge the divide between the technology and the old world with the new world. So as I said, cryptocurrencies are more like, to me, Bitcoin is digital gold. It's a store of value. It's not a payment system. And this is where I think people get very confused. Some of the other protocols are trying to be payment systems, but Bitcoin is very slow. It's very clunky. It takes 10 minutes for a transaction to go through the whole network because it's very secure. So the people that built Bitcoin were worried about their privacy and their security. Now, privacy and secrecy are two different things. I'll get into that, but it's a store of value. So I think that's an important description to have of Bitcoin. Digital assets, in what I've written, as I said, the broader category of these new digitalized assets, they exclude any transaction in which a business or part of an affinity or rewards program. So i.e. something like an airline rewards. I have Emirates points. I can't do much with my Emirates points outside Emirates and getting a bar fridge or some glasses or getting an upgrade. So that excludes that. And they also need to exclude a digital representation of value that is issued in some sort of online gaming platform. The challenges of global regulation. So yes, as I said, Bitcoin was the first adaptation of the blockchain technology, and it was the digitalization of money. So banks got upset, and everyone's like, "Oh, we're going to be made obsolete." That didn't happen. And my argument is, when the internet came into existence, banks didn't disappear; they just changed their business model. So technology, we need to embrace. We need to ensure that we understand it, but we don't need to be scared of it. And I think when we all work together, we collaborate, we build better regulation and better systems. So legacy institutions were under threat. As I said, it depends how you're viewing that threat. I think this is not disruption. This technology is more enabling than anything. We've got consumer protection versus investor protection. Data privacy across the world is very confusing. The European Union is very different to the US, very different to Australia. But the small nations and the Commonwealth, funnily enough, where we all have British law, are really leading the charge in this. And it's very difficult in, say, Europe or the US, where you have federal regulators and you have state regulators it's a big jar of spaghetti. So you can't get them to agree on regulations internally, let alone at a federal level. So AML CTF always comes up with virtual assets. So you've all probably seen the FATF guidance notes around Rec 15 and virtual assets. I really wish when the FATF were looking back in 2011-12 at this new paradigm shift to cryptocurrencies, they hadn't have called these new digital assets virtual assets, because in my eyes, virtual means things don't exist. These assets really exist now. So I think that was important, but for the sake of what a virtual asset is, it's a cryptocurrency. Now, everybody thinks that Bitcoin is used for nefarious activities and the dark web. And so there's a lot of bad information out there about Bitcoin, when in fact, I would argue that cash is still the best tool for any money launderer or terrorist to use, because it's not traceable. If I do something on the blockchain, it's immutable, it's traceable, and it's transparent. So we found over the course of the last few years, it's actually the best law enforcement tool that we've ever seen, because the cryptography enables multi-stakeholders and use cases that we technically couldn't look at a few years ago, so we didn't have the technology. But we can track and trace, and I work with a lot of the service providers in law enforcement. We can track and trace, all transactions that are done on the Bitcoin. So yes, technology is used for bad actors. The internet was used by bad actors, but we can actually now trace Bitcoin and cryptocurrencies because they're not anonymous. The other falsity in this is that cryptocurrencies are anonymous. They're not. They're what we call pseudo-anonymous, because everything that goes on the blockchain is immutable, transparent, and secure. So that's been a very big help. The FATF come out saying that with the travel rule, so you have to know as an exchange the beneficial owner of that cryptocurrency and who is selling it. So the buyer and the seller. That's coming into it. So I guess that's becoming much more adaptable to what the FATF require. And I'm almost finished. Oh, so the first movers in digital assets, as I said, was Australia, Bermuda, Malta, Singapore. A lot of the countries that have largely young populations, because I think it's important to note that if we over-regulate, it's very bad. We will stifle innovation. No regulation is absolutely worse, but so there has to be a happy medium, and that happy medium is industry, the regulators, the policymakers, all of us coming together to understand and cooperate to make sure that we do protect consumers and investors, because we don't want them getting hurt, and that's what the role of regulators is. Regulated role is not to regulate technology. It's very hard to regulate technology, but we can regulate the services and goods around that technology. So I think that's important. As I said, all the big policymakers are saying, we need to focus to ensure that we've got harmonized regulation, that it's adequate for these decentralized assets that don't live anywhere. They're global in nature. We need to understand the risks, and we need to mitigate them, but we also need to embrace the opportunities that this gives us. And especially, I have a 16-year-old. My little girl, uses this more than she doesn't, and I think it's an extension of her left hand. I can't stop her using the technology, but I can explain to her risk. And with the resurgence you've seen in cryptocurrencies at the moment, no one asset class goes one way forever. We all know that. Market forces and financial markets have told us that they don't. But if you want to invest in these things, you do it at your own peril. You make sure that you understand the technology first and foremost, and we build suitable regulatory frameworks, as I said, that mitigate risks but also harness the opportunities. So thank you. That's the end of my presentation, and I think we're going to have some questions now. So George.
Okay, thank you very much, Loretta, for this wonderful presentation. I think I have some few takeaways. Blockchain technology is immutable, transparent, and with a decentralized administrative architecture. Blockchain is the technology that powers Bitcoin. So it's time to take the first question from Solomon. Please.
Hey, hi Loretta. So my question is, some organizations are afraid of the disruptive character of blockchain technology, though you have said it is more of an enabler. But how can we convince these organizations that they won't be losing market share or going obsolete if they should get interested in blockchain technology? Thank you.
So the blockchain technology in itself, we look at the actual technology and it makes systems more efficient. So the processes and procedures that we all have in back offices, we all know that there's problems about, you know, execution time, costs, efficiencies. The technology itself enhances those. So I think that's good from a cost perspective. Now, the other side of the coin is too, for me, all technology is enabling. If we see it to be disruptive, then we'll never embrace it. As I said, the internet didn't knock out banks, yeah, but we've had new business models sort of grow out of technology, like the Ubers and you know, the Airbnb. These models have just changed, and the fact that the models are becoming much more customer centric is very important, because you as banks will find that your customers do a lot of stuff on their mobile phones. They have access to that. They want quick and efficient financial services, and yeah, technology and telecoms has certainly been providing that. So I do think it's enabling. I don't think it's as disruptive as everybody thinks. Obviously, the first, you know, the first application of blockchain was Bitcoin, and people did get very worried. But as I said, that didn't come into existence. Bitcoin isn't the payment system that everybody thinks it is, although it was branded to be a cashless payment system. It's very slow and it's very clunky, and you don't want to be using it to do payments. We have very good payment systems around the world. But then again, you are going to have generations of millennials. And where is this affected most? This technology doesn't affect me as a baby boomer, but I'm very cognizant when I speak to policymakers, because, you know, we didn't grow up with that in our left hand. There's the millennials and under this generation that understand technology. They understand mobile payments. They understand risk because they have access to information. The internet democratized media and the freedom of information. You see Bitcoin democratizing money. As I said, well, money is a different thing to everybody. And I think, you know, with what we've been seeing you know, in the last few weeks with the Reddit things, we're now seeing even investing to start to be democratized. So if you miss out on this wave and you become obsolete, I think that's a very sad thing. I think we can all benefit from the efficiencies in financial services that this technology gives us. We don't need to be threatened, and I don't think that's, you know, the case of innovation. Innovation is coming at such a rapid rate. We as you know, industry and regulators, we need to embrace it, because that's our generations. The next kids that come in, you know, they're entrepreneurs from technology. So we have to not stifle that. Does that answer your question?
Yes, it does. My question is well answered. Thank you.
And I just
thank you very much, Solomon.
I just have one more to add on. I just have one quick to add on it. So we're seeing this insurgence in cryptocurrencies. I think Bitcoin hit $52,000 today. People should never be buying markets on their highs. And I always say this as a trader now. I mean, it's very scary, but all you can say is buyer beware. Now, we can't stop you doing anything with technology, but we can, as regulators, give you the risks. And I also think banks need to start looking at this entire ecosystem, because up until now, Bitcoin is now $1 trillion market. This is the thing. Can we afford, as industry, as bankers, to ignore this new ecosystem? Is it a business decision or is it a compliance decision? So we have to look at these things very carefully, because I think the more mainstream it goes and the more people get into it, the more corporations like Tesla and PayPal, you have to be banking them. That's what banks do. So I think these are some important questions that need to be happening as well, that we need to embrace it, because the business opportunities that are lost, if we don't, are going to far outweigh the risks.
Okay, thank you very much. We'll pick another question from Enoch, please.
Hello, Loretta. Hello, Loretta. Hello, can you hear me?
Hello.
Yes, Loretta. My question is, what are the potential guidelines from a regulatory perspective towards cryptocurrency?
So in the regulation that I've written and the legislation, I've put cryptocurrencies down as a subset of a digital asset. A digital asset is now a new asset class. Like we have commodities, we have securities. This is just another asset class, but it's in digital form, and the technology has allowed us to do that. So, most of the digital assets that we're seeing, they have underlying value. So we can now digitalize a security, we can digitalize land title, we can digitalize a bar of gold. Intangible are the cryptocurrencies, and people say, oh, it's got no intrinsic value, but with Bitcoin, there's only 21 million of them ever created. So once it is digital gold in the fact that there's a finite supply, and people, for whatever reason, people like to buy things that are scarce. Like, we buy wine and we buy a commodity, we buy gold. You can only exchange things if somebody else seeks the value. So as I said, that's just a barter system. So if you decide that your tie is worth my bracelet and we swap it right now, well, that's a fair exchange. It's a barter system. And I think the regulations need to ensure that we're looking at cryptocurrency as commodity-like, not a currency, because it's not a currency. It's not legal tender. But these very important definitions are what we need to explore, because if everybody's talking about different things, nobody's ever going to understand what the underlying asset really is. So I think it's important, and that's what I've tried to do around the world, is have a standard, unified set of regulations that can go across jurisdictions, because this asset class is global. It's decentralized, so it doesn't live anywhere. So it's very important that we that we embrace it, but we have the similar set of regulations. And as I said, I think the British gave us one thing, a common law system. And in the Commonwealth, there's 53 countries. We all have exactly the same law system. Unlike Europe, unlike the US, well, we could actually roll out exactly the same regulations across the Commonwealth to address concerns and to give a proper regulatory framework that everybody can use.
Okay, thank you very much, Loretta. I think what we'll be doing now is I'm going to give you 3 questions, then we run through them then we go for the next set of 3. So yep. The first one is coming from Patrice Bakker. Do you know of any examples of banks or financial institutions that are already using blockchain technology? And if yes, in what way or ways?
So JP Morgan, I've written, so in blockchain technology, the regulations I've written, as I said, just don't go around cryptocurrency. I've been very concerned for the last 5 years about the custody of a digital asset. How the hell do I hold a digital asset? It's not like putting money in the bank or gold or a land title in a vault. It's very complicated. It's an asset that doesn't live anywhere. Exchanges, you all probably heard about getting hacked. Now, the reason the exchanges is getting hacked, not because the Bitcoin protocol is hackable, because I said it's the most secure database, but exchanges will take your cryptocurrency and they'll put it into a centralized database. So that makes no sense. So they've been prone to attacks because people like to attack honeypots of information. So a lot of the banks, Mellon last week announced that they were going to hold custody of cryptocurrency for their big institutional clients. That is a game changer. And I think, we all should be looking at that, because it's not like holding gold, but it's an important asset that people are still, as it becomes more mainstream, people will need to hold. JP Morgan have announced their own cryptocurrency. The big banks are using it, as I said, in back offices to make processes and procedures more efficient. You're seeing banks in the US and in Australia getting into networks so they can share information. So compliance. I think compliance is probably the most interesting use case, because compliance, you think about it, as banks, it costs us so much money. That's your biggest costs go into compliance and cybersecurity. So, but you look at how banks work. So with privacy concerns, if I go and open an account and I have a credit card, I have to give, I don't know if in Ghana, but in Australia and other places, I've got to give 100 points full of manual documents that say my passport, my driver's license, everything. And then I go to get a house loan and I've got to give it all again. So I worked out with compliance costs of banks, we have a right, we have to hold people's information, not share it across the bank. But these compliance costs are incredibly large, and they're about probably a lot for every person on the planet. So compliance cost and reducing that by using the blockchain technology, being able to share information with people you need to share it with but you don't trust, is probably one of the best use cases for banks and financial institutions that I can see. Digital ID. So I don't have to keep giving you 18 pages of my, my birth certificate, my passport. I could have all my digital ID in one wallet, and I could give it to the bank or the telecom when they ask for it. I give them authority to do that. So the use cases are far and wide, many, and there are many financial institutions. I said even exchanges are now doing clearing and settlement, atomically swapping assets. So these things are, are really exciting to me because I come from a financial market background, and the rate and pace of technology going forward is I can't keep up what was happening 2 years ago, let alone 3 months ago. You all should have a look, maybe for our next call, but have a look at decentralized finance. Oh goodness, $7 billion has gone into that in the last 3 months, and that's effectively peer-to-peer banking, asset management, wealth management, arbitraging, lending, borrowing. This is the next paradigm shift, so we have to be on top of it as industry.
All right, thanks. Let's pick another question from Solomon. How expensive is it to implement a blockchain technology? And how will an organization with business processes and technology be impacted? And the next one is the blockchain technology scalable? I think I want to just give you 3 questions that I don't know if you can take all at once. Is the blockchain technology scalable? And can it be integrated with organization legacy systems? Maybe 2 will be enough here.
That's a very good question. So my answer to that would be, what is the risk of a cybersecurity breach? And we've all had them. Every database in history, governments, banks, private companies, everybody's had a data breach in the last 2 years, and a data breach that's so expensive. So it's because we're holding all this information. So when we decentralize the information and it's not held in centralized servers, we take out the ability for hackers to hack, because hackers want to hack pieces of information that's worth something. So they want information, they have ransoms against banks. So my question would be, how much does it cost you to have a cybersecurity breach? Is my first answer to that, because I think as we move on with technology, and in 2021, our biggest concerns is cybersecurity and breach, and hacks from internally and externally. So the decentralized nature of the blockchain gives us a method that we can solve that very quickly. And what was the second part of that question?
Sorry.
George?
He wants to know if the blockchain technology is scalable enough to integrate with the system, the organizational systems.
So what we're seeing, probably 5 years ago when I first started looking at public blockchains and private blockchains, it's a trade-off. So a public blockchain is incredibly distributed, like every node on the planet, it can be every computer on the world can be part of the Bitcoin network, but that's very inefficient. Do we really want to be sharing information with every other person on the planet if we're sharing compliance documents? But it's very secure. So it's a trade-off. The fewer people you have, or the fewer institutions in a network, the less secure it is, but it gives you privacy. So I think the absolute public blockchains for some of the use cases with industry are not suited to it, because we don't want everybody on the planet having the same ledger to look at for everything. So the security is less, but the less people in the network, or the less institutions, or the less nodes you have, the more private it is. So I think what you're seeing now, for the first few years, we just had public blockchains, Bitcoin, Ethereum. Ethereum proved it wasn't scalable, which was lucky. My daughter had something called a crypto kitty, which scared me and security regulators around the world, because these things, she was breeding and they were selling for $20,000. And, I said to the SEC in the US, what are you going to do? Call in crypto kitty number 4 for breach of securities violations. So that network fell over. Ethereum hasn't proved to date that it can really scale. Bitcoin is proving now that it can scale. So I think what you're going to be seeing, and as I said, as cryptocurrencies and the technology move much more into an infrastructure, a back-end application, you're going to see the hardening of these protocols, and the scalability is being solved. So scalability, interoperability was a big problem, and social adoption. So all those 3 nuisance problems that we saw around blockchain 5 years ago are being dealt with. The Bitcoin network, as I said, is very slow, very clunky, but there's been something called the Lightning Network that has just been put on top of that network. And it's the throughput of transactions is becoming much faster, much quicker. So that's been the concern of institutions, is the throughput of transactions, because Swift is like millions of transactions a second. The scalability, it depends what the project is for. If you're doing a cryptocurrency, you know, like JP Morgan are, I have concerns about the limitation of the scalability. But as the technology, you know, it only came into existence in 2008. And, you know, 5 years ago, I wouldn't have thought we were where we are today. So the technology is moving so quickly and the innovation is moving so quickly. So we, as regulators and, you know, industry, we need to at least keep up. We don't need to be ahead of it, but we do need to keep up.
Okay, Hamda wants to know if the concerns of central banks regarding cryptocurrency are justified. So this, as I said to you, there's a lot of the misdemeanors and the falsities around cryptocurrency. As I said, you know, Bitcoin is not anonymous. It's what we call pseudo-anonymous. So we can track and trace every transaction since the inception of the first ever Bitcoin Genesis block, where they've moved and how they move. So it's not anonymous. And that's one of the biggest problems, that people have thought it was anonymous. As I said, you know, I started doing maybe about 4 years ago. There was a hit put out on a Japanese politician in Bitcoin. So all the security regulators, or the security regulators got together, or the law enforcement, and we geo-ring-fenced this Bitcoin around the big exchanges. So the cryptographers and the protocol developers, we could see it moving. So when we got onto an exchange, like some of the big ones, I think it was Kraken and Binance, we froze it moving. And the law enforcement said at the time that was the best law enforcement tool they'd seen. Forward to last year, there was a united effort around the world for human trafficking, and I think that the English, the Americans, the Australians, you know, there was quite a number of law enforcement that got involved, and people were moving Bitcoin in the dark web. What we could do with that movement of Bitcoin is we could see it going. So they were able to arrest 700 people across 400 jurisdictions in 5 minutes. And that was because of the blockchain and being able to see how the Bitcoin moved. So in fact, as I keep saying, cash, if you want to launder money or be a terrorist, use cash, because I can't trace it. We can all stand in a circle and move cash. Very hard to trace. But Bitcoin, we can track and trace it. So I think as the technology becomes more sophisticated, there's a number of service providers out there that work very closely with law enforcement all the time. People like Chain Analysis that work with a lot of the law enforcement and the FIUs. We're actually tracking and tracing and arresting more people that are using Bitcoin than we can ever do with cash. So that's my 2 cents on that. Is this is the best law enforcement tool we've seen. And if anybody thinks that Bitcoin is anonymous, they should go and have a look at the ledger. Okay, thank you very much. I'll pick my last question. It's coming from Abolaji. Is crypto trading a Ponzi scheme? Very interesting one.
It depends which one you're talking about. So as I talked about before, there was these initial coin offerings in 2017-18, where people were putting out sort of like a business plan, if you will, on the internet and saying, all right, we're going to build the next Google 15, no, the next Google 28, give us money now in cryptocurrency and we'll build it. So a lot of those were scams, a lot of them. And when I looked at it, they were trying to get around securities laws by saying that they were utilities. So they were just tokens used in a network. But of course they were used to raise money and investments, and a lot of people were getting this money and disappearing. So the way to get around that, I figured out back then, was the crux of it, and the crux of AML CTF provisions is, the beneficial owner. So if you can have regulations, and what we wrote in Bermuda was quite harsh, I think. So we could have civil, security penalties and civil penalties. And so if somebody scammed, a business came in, went onto the internet, put up, they had this business opportunity, and the beneficial owner of the company had to take responsibility. So we had a $10 million fine, I think, or jail, or both. So once you sort of start to put those sort of deep regulations around the scammers, they'll stop doing it because you don't want to go to jail. So I think that was the cause, and that was the concern of the FATF, was the beneficial ownership. So if you can have regulations in a jurisdiction that talk about the domicile of that company in a particular jurisdiction and who the directors are, and the directors have to sit in jurisdiction, you can actually solve that. And that's what we've seen probably over the last 3 years. The number of scams and Ponzi schemes has certainly died down from what it was when it was the Wild West, sort of between 2015 and 2017.
Okay, thank you very much, Loretta. I think that was the last question, as I said. But if you still have questions, please forward them to webinar@firstatlanticbank.com.gh, webinar@firstatlanticbank.com.gh. I would like to invite Mr. Amakwe Ama, the board chairman of First Atlantic Bank, to give his closing remarks.
Thank you very much. Can you see me on the screen?
Yes.
Okay. So I'd like to start by saying a big thank you to Loretta for the presentation, and also for Odun and the moderator, George, for the work you've done. I see from the screen that we have about over 240 participants, which is, I mean, it's great. Now, we don't have that much time, so I'd like to share a few observations. I mean, from listening to this and some of what I have picked up about this blockchain and cryptocurrencies and how it affects us, First Atlantic, as a commercial bank. The first thing is that we at First Atlantic are already embarked on a digitization drive, and what I've heard has the potential actually to accelerate this process, because with the open source finance infrastructure as described, this goes beyond what we've been doing on fintech. Okay, so it impacts potentially also on how we relate as a commercial bank with the central bank, our regulator. So this is something that we need to pay attention to going forward. Now, to add to observations on what I said about how it moves beyond fintech, I'd just like to point out two things in terms of how I see this, that in most of what we're doing with fintech is more like transformation, improving efficiency and so forth, but this goes far beyond it, because we're now going from the use of, let's say, deposits in bank, which we call analog type processes, to more digital processes, which is like tokens in wallets and so forth. We've been trying to do that on Momo, but this goes beyond Momo type of mobile money type of applications. Now, this means that the traditional banking business model that we are working with needs also to adapt to account for the open source finance infrastructure. And a good example just coming to mind is, for example, this could lower costs of doing business in many ways, because you're no longer distributing physical cash through bank accounts, branches, and ATMs, and you're moving beyond what we are typical, I mean, the Momo, you can go far beyond it and also go across borders with the exchanges that Loretta alluded to. So I think this is a good start, and I think we need to continue this process, but bear in mind that it's not so much disruption of the industry or the disruption of how we do business, but how we can adapt to keep up with this as part of our digitization drive. So with that, on that note, I would like to thank all the participants, and we need to find a way, Odun and his team, of how to continue this process and learn and also learn as we go along with our digitization process. I mean, First Atlantic Bank, one of our objectives is to be one of the premier digital banking organizations in Ghana. So I think this is part of the process of moving us towards our objective. Thank you very much for everyone's participation. And I'll hand it back to the moderator and Loretta, if you have closing statements to make. Thank you again.
Thank you very much, Chairman. And on behalf of the bank, I just want to say thank you to everyone who made this possible. And for all those who attended, if you still have certain questions that you need to be answered, I'll please ask you send them to webinar@firstatlanticbank.com.gh. And once again, thank you for coming. Hope to see you another time. Bye-bye.
Thank you, George. Thank you for having me. And if anyone does have questions, I promise I will endeavour to answer every single question that you have. I do really see that there's such an opportunity for Ghana in this whole new frontier. So good luck. And hopefully this will be the beginning of many long collaborations and exchanges of information.